So in this video, we will look at how we can use information from the financial statements, and then particularly earnings information from the income statement and equity information from the balance sheet. We will see how we can use that in our firm valuation process. In the previous video, we already discussed the basics of valuation. As an analyst, we are interested in determining the value of a company in order to see whether we want to invest in this company, yes or no. And we said that the value of the company today is a function of the future payoffs that we get from this company, discounted at the appropriate discount rate that incorporates time value of money as well as risk. And we also said that there were two periods to this valuation process. One being the forecast horizon, so the number of years for which we're going to develop specific forecasts of individual payoffs, as well as a terminal value in which we're going to say that there is a constant payoff stream that might grow at a constant rate in perpetuity. And we already looked at this first dividend discount model, where we said that the equity value of the company today is a function of the future dividends. So we could determine the value of the company by discounting the dividends that we are receiving from this company at the appropriate discount rate. So this model focuses on the cash that is paid out to shareholders as a driver of equity value. And of course, one of the concerns with this model was that a lot of companies don't pay out dividends, and it's not really consistent with how firms generate value. Generally, you don't really generate value by paying out dividends. The reason that you can pay out dividends is that you don't have any investment opportunities in which you can invest your excess cash. So in that case, the best thing that you can do is pay it out as a dividend. But this dividend discount model is then not really consistent with how firms actually create equity value. We then turned to the free cash flow valuation model in order to have a model that's more directly related to value creation by firms. So for this model, we said that we can see equity value as a function of the future free cash flows to equity that are generated by the company. So instead of focusing on money that's distributed to shareholders, we focus on money that's actually generated by the firm as a driver of equity value. However, we can also use information from the income statement to come up with a valuation of the firm. And that's why we have this abnormal profit, or also called residual income valuation model. And in this model, we see the value of the firm as a function of basically two components. One being the current book value of equity, and the other one being the present value of these future abnormal profits or future residual incomes that are generated on this book value of equity. So this model actually focuses then on value that's created by the firm. And once we generate income, this will immediately add to our equity value. And it doesn't matter when this income is received in cash. So this model actually more directly links value creation by the firm to the equity value of the firm. And we express the value of the firm as a function of current book value of equity plus the present value of all future abnormal profits. Now, the abnormal profits actually capture the profits that the firm is generating that are more than what is required by investors. So investors require a certain return. That's the discount rate that we use in the valuation process. And the abnormal profits actually capture the profits or earnings that this company is generating over and above what is required by investors. So the investment of investors you can see as the book value of equity. That's how much investors, from an accounting perspective, have invested in this company. That's their stake in the company. And it's on this book value of equity, on their investment, that shareholders require a certain return, this cost of equity. So this component, the cost of equity times the book value of equity, captures the normal or required profits that investors expect from this firm. They have a book value investment in this firm, and on this investment they want to at least earn the required rate of return. So this RE times the book value of equity, that captures the normal profit that investors expect from this firm. Any profit that is higher than this is called the abnormal profit or the residual income. So this would mean that the profits that the company is generating are higher than what investors are actually expecting given their investment in the firm, so given the book value of equity, and given the risk and required return that they want to have. So you can see then that a firm can increase equity value by generating profits that are higher than what investors expect given their investment and given the risk in this company. So the firm can increase equity value by increasing the abnormal profits that they are generating. And you can see this from a net income perspective, but also from what we've seen before in the financial analysis sessions from a ROE perspective. So basically, the company is adding value whenever their return on equity, the return they are generating for investors, is higher than the cost of equity, the return that investors expect on this investment. Now, given all of this, you can also see then that the book value of equity is sort of the benchmark against which we can evaluate equity value. And you can see then that in order for the equity value, so the market value of the company in the stock market, in order for that to be higher than the book value of equity, that must mean that the company is able to earn abnormal profits or residual income. If the company is just able to earn the normal return on the book value of equity, investors shouldn't be willing to pay more than this book value of equity for the firm. So investors will be willing to pay more for this company, and they are willing to pay more than the book value of equity if the profits that this firm is generating on this book value of equity are abnormal. We can also see this graphically. So the starting point for the value of the firm is the book value of equity. If we are not able to earn any abnormal profits, the value of the company or the equity value of the company should be equal to the book value of equity. Now it's on this book value of equity that we're going to earn a certain income in the following year. And we can split this income into the required income, so the cost of equity times this book value, and any income that we have on top of that is our abnormal profit or residual income. And it's this last component, or the present value of this last component, that we add to the value of the company. So we start with the book value, and then we add to that the residual income that we are generating. And we can continue like this. So assuming that we don't pay out anything as dividend, the income that we earn in year T+1 gets added to the book value and will form the basis for year T+2. So in year T+2, our required profit has actually increased because it's still the cost of equity, but it's now multiplied with this higher book value of equity. If we reinvest assets, the book value of equity goes up. So if we invest more, we also expect more in terms of profits. So if we reinvest and the income gets added to our book value, this will also increase the required return. Our investment increases, so also our required profits are increasing. Still then, if we earn more, we again have residual income, and we also add the present value of the second year residual income to the value of the company. And then basically this entire process continues. If we still reinvest our entire income, the book value of equity will increase even more, and so will the required profit. It's now required on this even higher book value. Yet, if we still earn residual income, we can also add the present value of the residual income again to our firm value. And you basically continue like this. And we can see the value of the firm then as the beginning book value plus the residual income levels that we're earning over the life of this firm. So as an alternative, we can also use the abnormal profit growth model. And this model is closely related to the abnormal profit or residual income model. But instead, what we use here is not levels of abnormal profits, but we will make use of changes in abnormal profits. And we basically say that the equity value can be seen as the function of capitalized period 1 profits. So whatever net profit we have next year, we assume that we will have that indefinitely. And then we will adjust the equity value for the present value of changes in future abnormal profits. So instead of starting from book value and adding levels of abnormal profits, we start from next year's profit and we will make adjustments for abnormal profit growth in the years after that. Where then the abnormal profit growth is a function of the change in net profit and normal profit growth. And for normal profit growth, we will look at the reinvestment that the company is making. So normal profit growth is a function of the net profit that was earned in the previous year, less the dividend that was paid out in the previous year. Because this is the reinvestment, and this will be the change in the book value of equity that we also saw in the previous slide. So if we earn a profit and we retain a portion within the firm, so we don't pay everything out as a dividend, this increases the book value of equity and this increases the required profit. And that's what you see here with the normal profit growth. So the cost of equity or the required rate of return times the change in the book value of equity, so last year's net profit minus last year's dividend, that determines the normal profit growth. So the abnormal profit growth would then be what is the change in profit from last year to this year, and what is the normal change in profit that we would expect given the reinvestment that was made. And then basically what we will do is we will take all these abnormal profit growths and we again assume that these changes are happening indefinitely. So take every abnormal profit growth and then multiply each of these with 1 over the cost of equity. Because what we're saying is if we have, let's say, an abnormal profit growth of 3 euros next year, this will persist into the future as well. And any net profit growth we will have in the year after that comes on top of profit growth that we have next year. So that's why we multiply everything in brackets still with 1 over the cost of equity. Any abnormal profit growth persists and also affects the years after the year in which we have the abnormal profit growth. Which is nice because this centers the valuation around a key number that's forecasted by analysts. Analysts generally spend a lot of time on forecasting next year's profit, and you will see that next year's profit plays a big role into the valuation. A lot of the equity value depends on next year's net profit, and it's exactly on this number that analysts spend a lot of time on forecasting. And it also helps us to see how value is created, because value is created by having growth in abnormal profits. If we have growth in profits, but those profits are not abnormal, this is not helping us in adding value to the firm. If we reinvest a certain amount, and on this reinvestment we just earn the required rate of return, well, this is not adding any additional value. We just earn exactly what investors require, so this does not increase the amount that they are willing to pay for this firm. So profit growth or earnings growth actually only adds value if it's abnormal and if we earn at least the required rate of return. If we make reinvestments, but those reinvestments don't even earn us the required rate of return, we are actually decreasing value by reinvesting money back into the business. Now, as discussed before, we split the life of the firm into two components or two time periods, one being the forecast horizon. So it's for this period that we actually make detailed forecasts, and we group all of the years after that into this terminal value. So you can see that given the number of years that is included into this terminal value, whatever we assume about growth after this terminal year can have a big impact on our valuation. And there are several assumptions that we can make when it comes to the terminal value. And these differ in terms of what are the implications for the abnormal profits that we are generating. And the most, let's say, strict or conservative assumption is the competitive equilibrium assumption. Because here we say that if a firm has abnormal profits, this will attract new companies into this market, so there will be more competition. And in the long run, these competitors are forcing down margins, and they make that after this terminal year, the firm is no longer able to generate abnormal profits. So basically, in this assumption, we say that in the terminal year or after the terminal year, there are no abnormal profits anymore. Now we can also say that we can still retain abnormal profits, but that they are not growing. And that's this second one, abnormal return on constant sales. So whatever abnormal profit we had at the end of the forecast horizon, we can keep that, but it's not growing. So if we had 1,000 in abnormal profits in the last year of our forecast horizon, we say that we will have this indefinitely, but it's not growing. So for each of the years in our terminal value, the abnormal profit will be 1,000. Or we can also say that this abnormal profit persists, but it's growing. And we can say that it grows, for example, with the inflation rate, which means that in real terms, consumption did not increase. It's not that people are suddenly buying a higher volume of products, but we can increase the prices of those products in line with inflation. So there will be future growth in abnormal profits, but this growth will move in line with the inflation rate. But we can also say that sales grow at a rate that's actually higher than inflation. So maybe we say that sales are growing at 3% and inflation is 2%. So we also say that there is additional growth on top of just increasing prices on our products. Now keep in mind, you have to benchmark this against the long-run economic growth rate, because you cannot forecast, let's say, 10% sales growth forever, because if you continue like this, then at some point one company will make up the entire economy. So you can forecast a rate that's higher than the inflation rate, but keep in mind that it shouldn't be unrealistically high. And growing, for example, at 3% forever is actually already quite an accomplishment. As an alternative, we can also use multiples to determine our terminal value, where we would say that after the terminal year, the value of the firm is equal to a certain financial statement item times a multiple applied to this financial statement item. For example, we could say that after the terminal year, the value of the company is equal to 3 times book value, in which case we can use the value to book ratio, for example, of other companies to determine what this ratio should be. Or we could say that the value of the company is going to be X times the last earnings that were generated, or X times the last sales that were generated. And this has some benefits because it's generally relatively easy to implement. You know the last book value, you know the last earnings or sales number, and you apply a multiple that you see, for example, for other firms to value this company. Which also means that you tend to focus on key aspects that are important to investors. Investors look at sales, they look at earnings, they look at book values, and you directly express the terminal value as a function of these key aspects. Which, if you use, for example, other companies, or you use publicly traded companies for this, you tend to also incorporate views of all investors. If you see that investors value other types of firms or similar firms at a certain multiple, well, then you can also apply this multiple to this specific company. Which of course also has some limitations, because it might actually be complicated to find a comparable firm. So if you look for comparable firms that are similar, such that the multiples at which these firms are trading are also relevant for your firm, you have to take into account differences in these firms, such as, for example, differences in the accounting methods. In addition, you're also assuming that the market is right. So you're looking at a realized multiple for other companies, and then you apply the same multiple for your company that you're valuing. However, it could be that investors are too optimistic or too pessimistic for these other companies from which you're using the multiple. So it could make more sense to spend a little more time on trying to develop a detailed terminal value forecast yourself, rather than saying, I just take a similar multiple that investors are applying to other firms. In addition, there are certain cases in which multiples might not be so useful. For example, if a firm is loss-making, or if a firm is really small, or has like temporarily depressed earnings. In this case, especially these lower level multiples like earnings might not be so useful. So for these companies, it might actually be more useful to, if you use a multiple, use like a higher level multiple like sales. If they have temporarily depressed earnings, it's not really fair to use those earnings and then apply a multiple to this last temporarily depressed earnings level. So in this case, this higher level multiple, for example, on sales, might make more sense. But as said before, it might be better to actually create a competitive advantage yourself by trying to estimate what the terminal value should be, applying your own unique insights instead of relying on some average that you see in the market. So as a conclusion, these multiples can be useful. However, they are generally not a substitute for your own more detailed analysis. However, they might be a nice benchmark against which you can compare your own terminal value estimate. Let's say you make a certain terminal value estimate, you can compare or you can see what this implies for the value to book ratio or for the sales multiple, and compare this to what you see in terms of multiples for these comparable companies. Now, if you want to look at what drives an actual multiple, we can actually go back to our abnormal profit and abnormal profit growth model. So let's start with the value to book multiple, or market to book ratio. What drives the market to book ratio, or value to book, is the ability to earn an abnormal ROE. And we can see this by going back to our abnormal profit model and dividing that by the beginning book value of equity. Because what do we get if we divide by the beginning book value of equity? Well, out of our abnormal profit model, we got an equity value. So if we divide that by the book value, we actually get the market to book ratio. We get the equity value to book ratio. And we can then see that this is a function of, again, the beginning book value of equity, but in this case that will be a 1, and then the ability to earn abnormal profits. So as said, the beginning book value of equity divided by the beginning book value of equity will be 1. And that has the same intuition as before. If a company is not able to earn abnormal profits, then the ratio that you're willing to pay on this book value is equal to 1. If you don't earn any abnormal profits on your book value of equity, you're not willing to pay more for the company than the book value of equity. where then the equity value but also the value to book ratio depends furthermore then on the ability to earn abnormal profits. And in the value to book formula, this is the ability to earn an abnormal ROE. So you're willing to pay a higher multiple on the book value of equity if the return on equity that you're generating is higher than the cost of equity. Now the tricky thing here in the formula shows up if we look beyond year one, because then we have to take into account that the abnormal ROE that's earned in those years is earned on a book value that has grown because of reinvestment. So if we look at the abnormal profit in year two, that's the profit or loss in year two minus the cost of equity times the book value after 1 year. So in the value to book formula, we incorporate that by looking at the book value growth in equity. So the abnormal ROE that we earn in year two is earned on a book value that has grown from year 0 to year 1. And that's what you see in the formula coming back as 1 plus G1 equity. So that's the growth in book value from period 0 to period 1. And the same is true for later years. So the abnormal ROE earned in the third year is earned on a book value that has grown in period 1 and a book value that has grown in period 2. So that's what you still have to incorporate in this equity value to book ratio in the calculation of that. If you earn a certain abnormal ROE, in later years we have to take into account that this is earned on a book value that has grown over time. Which is also what you see here. So the valuation starts or is anchored on this beginning book value. And if we don't earn abnormal profits, value to book should be equal to 1. Then we can increase our value to book by earning an abnormal return on equity. But we have to take into account in later years that this is earned on this growing book value base. So for G1 equity, this is earned on the book value at the end of year 1 and not the book value that we had at the beginning. So that's why we take into account this book value growth. And we have to look at the compounded book value growth for the subsequent years. So we can see then that the value to book ratio or the value of the firm depends on the book value, the ROE, because that determines our abnormal ROE, the growth in book value, because that affects the, let's say, normal profit growth, and it depends on the discount rate. If we have higher discount rates, that means we have higher required or higher normal profits, which reduces our ability to earn abnormal profits. And we can see something similar for the value to earnings ratio or price to earnings ratio. So the price to earnings ratio, we can actually see what drives this when we look at the abnormal profit growth model, because we will get the price to earnings ratio by dividing the abnormal profit growth model by net profit in year 1. And then we will see, for example, that net profit 1 over RE becomes 1 over RE. So if we look at the value to earnings ratio here, we see that if there is no growth in abnormal profits, and basically this entire thing in brackets will be 0, then the value to earnings ratio is equal to 1 over your cost of equity. We have a certain net profit level next year, and we will have that indefinitely. And the multiple that you're willing to pay on this depends on the cost of equity. And basically the multiple that you're willing to pay is equal to 1 over your cost of equity. Now we can increase the value to earnings ratio by earning or having growth in the abnormal profits. That's what we also saw on the abnormal profit growth model. The starting point was next year's profit, and we can add value by increasing the abnormal profits included in that. And that's what we see here as well. So in order for value to earnings to be higher than 1 over your cost of equity, we need to have growth in abnormal profits, which is a function of profit growth, but minus the normal profit growth that we expect given the reinvestment. And that's what you will see here. So D1 minus 1, that captures our reinvestment. Multiplied with the cost of equity, that gives us the normal profit growth that we expect given the reinvestment that we are making. Or in this case then, it more or less gives us the percentage of normal profit growth that we have or expect given the reinvestment. And G2 profit similarly gives us the percentage of profit growth that we have in this second year. Now what we have as well, and we saw this also when we looked at the value to book ratio, we have to take into account that in subsequent years we have profit growth on profits that have grown in previous years as well. So if we, for example, look at the profit growth in year 4, we have to take into account that this percentage of growth is earned on profits that have grown in year 2 and year 3 as well. So just like what we've done with the book value, we said that the abnormal profits were earned on a book value that has grown over time. We do the same here. Profit growth in year 4 is generated on profits that have grown over the previous years as well. And that's what we will take into account here now with this compounded profit growth as well. So we can see in this case that the value of the firm depends on next year's profits, the reinvestments that we make, because those determine the normal profit growth, then the growth that we have in abnormal profits, and again then the discount rate. So we're willing to pay a higher earnings multiple if there is less risk and if the discount rate is by extension lower. Now let's look at an example in which we're going to apply all of this. So we have the following information for firm ABI. They have a cost of equity of 10%. The book value at the beginning of period 1 is 500. Earnings for period 1 to 3 are 100, 105, and 110.25. And we know the dividend payout ratio, that's going to be equal to 75%, which also means then that the reinvestments are equal to 25% of the profit. We use this information to determine all the inputs that we need in the valuation process. So I said we begin with a book value of 500. On that we earn a profit of 100, which means that the abnormal profit is 50. The cost of equity was 10%. 10% of the 500 beginning book value gives us this required profit of 50, which also means that there is 50 left as abnormal profit. In this case, there is no abnormal profit growth yet, because this is the first year in which we actually look at profit. The ROE is 20% because we earn 100 on a 500 euro investment. And in terms of book value growth, there is no book value growth yet, because again, this is also the first year. And the same is true for profit growth. Now, if we look at the second year, we said that we were going to reinvest 25% of our profit. So out of the 100 profit that we generated in year 1, 75% was paid out and 25% was reinvested. So that makes that the beginning book value now in year 2 is 525. On this we earn a profit of 105. The required profit is 52.5. 10% now of this new book value of 525, and it leaves the same amount as abnormal profit. Which now also makes that we have our first growth in abnormal profits, because from year 1 to year 2, abnormal profits have grown from 50 to 52.5. So we have abnormal profit growth of 2.5, and in a percentage that means that we have 5% profit growth. We've also have book value growth, because book value has grown from 500 to 525, so that's also a 5% growth level. And we can continue like this. So in year 3, we again reinvest 25% of our profits. That makes the beginning book value equal to 551. On that we earn this 110.25. Half of that is required profit, half of that is an abnormal profit, implying abnormal profit growth of 2.63. The return on equity is still the same. Book value has grown by 10.25% from year 1 to year 3, and profits again have grown at 5% from year 2 to year 3. And these would be all the inputs that we need to determine firm value using the abnormal profit or abnormal profit growth model, and to determine value to book and value to earnings as well. And that's what we're going to do now, and we're going to do so using different terminal value assumptions. So let's start with the abnormal profit model, and we're looking at the competitive equilibrium assumption, meaning that there are no abnormal profits anymore after the forecast horizon. And in this case, we can see that the value of ABI should be 630.26. We start with a book value of 500. And we add to that the abnormal profits that we generate over the forecast horizon. So next year, or in year 1, we will earn 50 in abnormal profits, which we need to discount for 1 year. We earn 52.5 in the year after, which we need to discount for 2 years. And we earn 55.13 in the 3rd year, which we need to discount for 3 years. And then I said in this case, the terminal value assumption is the competitive equilibrium assumption, meaning that there are no abnormal profits anymore. So basically the terminal value in this case will be 0. We have the beginning book value of equity. Those are essentially our normal profits. We have 3 years of abnormal profits in our forecast horizon. And then there are no abnormal profits anymore. So the terminal value would be equal to 0. Now we can also determine firm value using the abnormal profit growth model. And as you can already see, the end result is the same, and that's also what it should be, because in the end these models are closely related. So whatever model we use, we should get to the same end result. Now with the abnormal profit growth model, the starting point is next year's profits. And those are 100. The net profit in period 1 was 100. If we say that we have that indefinitely, we divide it by the cost of equity, and that's our starting point. And then we add to that abnormal profit growth over the forecast horizon. So from year 1 to year 2, we had abnormal profit growth of 2.5. And from year 2 to year 3, we had abnormal profit growth of 2.63. So we discount those, the growth from year 1 to year 2 for 1 year, and from year 2 to year 3 for 2 years. And then we still have to divide all of that by 0.1 or multiply it with 1 over 0.1. Because basically what we're saying is, if we have abnormal profit growth in 1 year, this persists forever, which is why we still multiply all of this by 1 over 0.1. And that's the forecast horizon. Then we still need to look at what happens in our terminal value window. And in this case, we actually have negative abnormal profit growth. We can see it from the abnormal profit model. The abnormal profit that we had at the end of year 3, so at the end of our forecast horizon, was 55.13. Now what we're saying is that in our terminal value window, we don't have any abnormal profits. So basically abnormal profit growth is minus 55.13. That's what we had in abnormal profits, and that goes to 0 now in our terminal value window. So we get rid of 55.13 in abnormal profits. And again, multiply this with 1 over 0.10, because if it reduces in 1 year, it will be gone forever. So we're not only saying that abnormal profit growth is minus 55 going from year 3 to our terminal value window. If it's gone and it will be gone forever, which is why we still multiply it with 1 over 0.10. So then if we look at what do we have under this model, we have next year's profits permanently capitalized, the 100 over the 0.1. We add to that the abnormal profit growth over the forecast horizon, the 2.5 and the 263, and we say that that continues indefinitely. And we also have the negative abnormal profit growth in our terminal value window, the minus 55.13, which if it's gone, it's also gone forever. And you will see that the value that you get is the same as what we had under the abnormal profit model. Now we can also look at the value to book ratio, where the assumption here in terms of terminal value is the same. The value to book model follows from the abnormal profit model. So if the terminal value is 0 in the abnormal profit model, it's also 0 in the value to book model. And instead of having this 500 beginning book value, the starting point here is 1. The value to book ratio should be 1 if there are no abnormal profits. And we add to that in this case then the abnormal ROEs. So the return on equity in year 1 was 20%, the cost of equity was 10%, so the abnormal return on equity is 10%. And we need to discount that for 1 year. For year 2, we again have an abnormal return on equity of 10%. However, we have to take into account that this is now earned on a book value that has grown with 5% from year 0 to year 1. So the abnormal return on equity in the second year is earned on this book value that has grown by 5%. And the abnormal return on equity in year 3, we have to take into account that this is earned on a book value that has grown by 10.25% over the previous 2 years. And as I said before, terminal value is equal to 0 because there are no abnormal profits or there are no abnormal return on equities anymore. Plug all of this in and you will get a value to book of 1.26, which you can also cross-check because we know the beginning book value, that's 500. We know the value that we estimate from the abnormal profit model, that's 630.26. And if we divide the two, we will get to the same result. Now the value to earnings model looks a bit more messy, where in terms of terminal value, what we have to do is remove the abnormal return on equity that we had at the end of year 3. But let's start with the beginning. So the starting point for the value to earnings is 1 over our cost of equity. And that's what we also see here coming back as starting point. So in this case, we would say if there is no growth in abnormal profits anymore, the value to earnings ratio will be equal to 10, 1 over 0.1. Now we have to adjust this for abnormal profit growth that we have over the forecast horizon. So profit growth from year 1 to year 2 is 5. But we need to adjust this for the normal profit growth because we're interested in abnormal profit growth. The dividend payout ratio is 75%. So the reinvestment is 25. And that's what you will see for the normal profit growth here. We have the 0.75 minus 1. That will give us minus 0.25, which is the reinvestment that we're making, times the cost of equity, and that portion gives us the normal profit growth. Discount that for 1 year. Now we do the same for the second year. We again have normal profit growth because of a reinvestment. So we again have 0.75 minus 1, so that's minus 0.25 as reinvestment, times the cost of equity that determines our normal profit growth. We again have 5% overall profit growth, and the net of those two will give us the abnormal profit growth. But as we've seen before with the value to book, we have to take into account that the profit growth in going from year 2 to year 3 is earned on profits that have grown from year 1 to year 2 as well. So for the second component, we multiply the abnormal profit growth with 1.05, which is actually the profit growth that we had in the previous year. And then we need to remove any abnormal profits that we had at the end of the forecast horizon, because the competitive equilibrium assumption says that there are no abnormal profits anymore. And that's what we're doing here. So we're removing the last abnormal profit that we had. And for that, we will use the value to book terminal value. So from a value to book perspective, the abnormal ROE that we had at the end of the forecast horizon was 10%. We had an ROE of 20%, cost of equity was 10%, so the abnormal ROE was 10%. And we earned that on a book value that had grown with 10.25%. Now that was the effect on the value to book ratio. We can turn this into an earnings multiple by multiplying this with 1 over the return on equity, which was 20%. So by doing so, we turn the value to book ratio into a value to earnings ratio. And then what we have to do is we have to remove this, because we say that there are no abnormal profits anymore after the forecast horizon. So basically what we will do is we will remove the last abnormal ROE, multiply this with 1 over ROE to make it an earnings multiple, and then again multiply it with 1 over 0.1 because any abnormal profits are gone forever. If we plug this in, we will get a value to earnings ratio of 6.3, which we can again cross-check because the value of the firm was 630, first year's profit was 100, so that leads to the value to earnings ratio of 6.3. Now let's see what happens if we change our terminal value assumption to having an abnormal return on constant sales. As you might remember, what it means is that whatever abnormal profit we had at the end of the forecast horizon, we will keep it, but it's not growing. And that's also what you will see now as terminal value in the abnormal profit model. The abnormal profit in the first year of our terminal value window will be 55.13 because it's not growing. So the abnormal profit that we had at the end of year 3 is also the abnormal profit that we will have for all of the years after that. So we will take our last abnormal profit, the 55.13, discount it to the present, and say that this is there indefinitely. So we still multiply it with 1 over 0.1. Because we will have this 55.13 not only in year 4, the first year in our terminal value window, but for all of the years after that. And you will see what it does to our valuation, because it actually goes up from 630 to 1044. Now in this situation, the abnormal profit growth model now has a terminal value equal to 0. Because there is no abnormal profit growth. The abnormal profit at the end of the forecast horizon was 55.13, but the abnormal profit for all of the years after is also 55.13. So in the previous situation, abnormal profits went to 0, and that's why we had this minus 55.13 as abnormal profit growth. In this situation, abnormal profits stay the same. So in this case, for the abnormal profit growth model, the terminal value is equal to 0. And we only have next year's profit and the abnormal profit growth over our forecast horizon as inputs now in this model. And what we saw for the abnormal profit model, we also see for the value to book model, where we also say that we permanently have the last abnormal ROE. So the permanent capitalization of this 55.13 abnormal profit you also see in the value to book formula, where we will permanently have the last abnormal ROE, which was 10%. We had an ROE of 20%, cost of equity of 10%, and this was earned on a book value that had grown at a 10.25% rate. So this is the last abnormal ROE, and we will have that indefinitely. So multiply it with 1 over 0.1 and divide it by 1.1 to the power 3 to get to the present value. But it's basically the same as what we see in the abnormal profit model, where we have the last abnormal profit, and then for the value to book model we will have permanently the last abnormal ROE. And we will get to a value to book ratio of 2.089, which we again can cross-check with the value that we get from the AP model. Where then if we look at the value to earnings model, again, a similar situation as what we saw with the abnormal profit growth model. There is no abnormal profit growth in this case, so the terminal value here in the value to earnings model is also going to be equal to 0. And in terms of value to earnings ratio, what we have is the permanently capitalized next year's profit, so the 1 over the 0.1, plus the abnormal profit growth over the forecast horizon. Now let's see what changes if we say that we will have 5% long-term growth forever. So in the previous situation, we said that whatever abnormal profits were there, we could keep, but they were not growing. What we say here is that the abnormal profits that were there, we can keep them, but they are also growing at a 5% rate forever. If we look at the AP model, and you will see in red everything that changes as a result of this growth assumption. So in the AP model, instead of having 55.13 as the abnormal profit or the first abnormal profit in our terminal value window, we will have 55.13 multiplied with this 5% growth rate, and that's going to be the first abnormal profit in our terminal value window. And then instead of multiplying this with 1 over 0.10, we have to take into account that not only is this growing at 5% for the first year in our terminal value window, but it will be growing at 5% forever. So instead of multiplying this thing with 1 over 0.1, we multiply it with 1 over 0.1 minus 0.05 to take into account that it's growing at 5% forever. And we will see something similar for the APG model. So in the previous situation, there was no abnormal profit growth. Any abnormal profit that was there we could keep, but it was not changing. In this case, we say that abnormal profit growth is also growing at a 5% rate. So the first abnormal profit growth in our terminal value window is the 2.63, but also here multiplied with 1.05. And then we again have to take into account that also in the years after that, there will be abnormal profit growth, and the abnormal profit growth will be growing at a 5% rate, which is why you see those two things. So first, to take into account that abnormal profit growth is growing at 5% forever. That's the 1 over the 0.1 minus 0.05. So abnormal profit growth in the first year is 2.63 times 1.05. But we will also have abnormal profit growth for all of the years after that. And that's why we multiply this with 1 over 0.1 minus 0.05. But then we also have to take into account, as always with abnormal profit growth, that once we have a certain growth level, this growth level itself is also there indefinitely. So growth in year 5 comes on top of growth in year 4. So to take into account that any growth in year 4 is recurring, we again still multiply this with 1 over 0.1. Now that's for the valuation models in terms of euros. If we look at value to book, we will see something similar. where we have to take into account then that the last abnormal ROE is now also 5% higher. So for the AP model, we multiplied the last abnormal profit level with 1.05 to get to the abnormal profit level in the first year of our terminal value window. For the value to book, we do the same, and we take the last abnormal ROE and multiply this with 1.05 to take into account that the abnormal ROE is growing at 5%. And also here then, to take into account that it will be growing at 5% forever, instead of multiplying this with 1 over 0.1, we multiply this with 1 over 0.1 minus 0.05. And then we will get values that are equal to 1500 and a value to book that's equal to 3. Now, just to make sure, so why do we have twice this capitalization factor in the APG model? Because we multiplied it with 1 over 0.1 minus 0.05, and then again by 1 over 0.1. I said this 1 over 0.1 minus 0.05 is taking into account that we will have abnormal profit growth for each of the years in our terminal value. So basically it takes into account that abnormal profit growth in the first year is 2.63 times 1.05. Abnormal profit growth in the second year of our terminal value window will be 2.63 times 1.05 times 1.05, and so on. So in each of the years in our terminal value window, we will have abnormal profit growth, and this abnormal profit growth is growing at 5%. And that's what we capture with this first component, the 1 over 0.1 minus 0.05. But then we have to take into account that the 5% growth in the second year is earned on earnings that have grown also already in the first year. And any growth levels are recurring. If we have earnings growth, this is permanent, and this will be a permanent increase in abnormal profit, which is why we had the second component multiplying this also by 1 over 0.1. And then now we can also look at what this means for the terminal value of the value to earnings multiple, where also here we look at the last abnormal profit growth percentage, but we also take into account that this is also growing at a 5% rate. So we have the abnormal profit growth of 5. We still have the 25% reinvestment that multiplied with 0.1 gives us our normal profit growth. And we now take into account that we earn this 5% growth on earnings that have grown at a 10.25% over the previous 2 years. Then any profit growth that we have is there indefinitely, so multiply it with 1 over 0.1, and we will also have abnormal profit growths in each of the following years, and they are also growing at 5% for each of the following years, which is why also here then we multiply it with 1 over 0.1 minus 0.05, which will give you an earnings multiple of 15, which we can again cross-check with the value that was 1500 over next year's earnings of 100, and that will give you your value to earnings multiple of 15.